All right, let's go ahead and get started with our fourth lesson. As usual, please take a moment or two to read the disclaimer. And let's begin now by looking at our agenda for today. We're basically going to delve into three key areas. First of all, I'm going to review some of the key concepts and market profile elements that we've covered so far. I want everyone to be very comfortable with them because we're going to move a little bit quickly here into some of the analytical techniques that we'll need to use. And unless we have the basic concepts down, it'll be a little bit difficult to follow the analysis. And then we're going to talk a little bit about time frame and how the time frame impacts our trading decisions and influences the market behavior. And last but not least, we're going to get into a detailed analysis of the short-term trader behavior in the market and how that manifests itself on a profile chart. All right, let's begin by a quick review together. So we're going to look at some of the elements that I hope by now everyone is comfortable with and is familiar with. And let me begin by asking everyone in the class a quick question. You have a profile before you, and I want you to please type an I if you see an imbalanced profile, or the letter B if you see a balanced profile. So is this a balanced or an imbalanced profile? Now let's see. I'm getting a couple of I's. Give everybody a chance here to type in. Okay, I have a B, I have an I. All right, I'm still missing about 2 or 3, giving everybody a chance to respond. All right, well, the ayes have it. The correct answer is this is, in fact, an imbalanced profile. And this is one of the key things that we want to learn to quickly be able to identify. The easiest part in the analysis of a profile is actually to analyze things after the fact. So it's very easy here to see that, in fact, we had a directional move in the market, and it is a narrow profile. Yes, there's a little bit of an area here where we tried to form a balance, but we never quite got a very large balanced area. So this is definitely an imbalanced profile, and that is an important observation to be able to make once you look at a chart to discern whether it is balanced or imbalanced. All right, there are 7 other key things that I want to make sure everyone in the room now is able to identify and understand on a profile chart. And we will begin with the value area. All right. What are the parameters of the value area on this chart? When I say the parameters, I mean what is the bottom limit and what's the top limit of the value area. And if you can give me the bottom limit first. The bottom limit on our value area that we see is 1262.75, and the top limit is 1268.75. Now, the reason I want to highlight these numbers for you is they're going to become important reference lines for us. So it's not just enough to be able to identify the value area, but you need to also be able to identify the parameters of the value area, where it is an extreme at the low and where it is at the extreme at the top. So our value area here is defined by the price range from 1262.75 all the way up to 1268.75. That defines for us our value area. Here they are again, 1262.75 all the way up to 1268.75. Now, the second item that you need to be able to identify immediately from the chart is the initial balance. This is a very important element of the market profile, and we will spend a lot of time today talking about this. The initial balance is, again, the first two periods of the profile, the letter A and B. A nice thing that the market delta does for us is it actually draws reference lines to help us identify these key elements on the chart. And I always like to use the same colors on every chart for these various elements because it helps me to be able to identify them easily. So if you noticed, typically I will always have green lines for my value area, and for the initial balance I will always use a blue line, as you see here. And now, if I were to ask you what are the parameters for the initial balance, it should be a very easy question for you to answer. The lower limit of the initial balance is 1260.75, and the upper limit is 1266.50. So now we've identified our value area and the limits for it, and we've also identified the initial balance and the limits for it. All right, now the open range. The open range is basically the range of the price movement from when the market opened till the first hour, the first half hour of trading. So we're only looking at the A period. That's really our open range. That's the very first period of the day. And even though market delta did not give us lines to identify for us the top and the bottom of this range, it should not be difficult for us to do that on our own. First of all, we need to be able to identify the open itself, and the open was at 1262, exactly at 1262. Now, prices dropped from the open, and they also went up. So the range encompasses the entire movement, not just from open to close, but the entire span, all of the TPOs, every single price that was printed during that first half hour comprises the open range for me. So in this case, my open range is all the way from 1260.75 all the way up to 1264.50. That's my open range. And I will explain to you a little bit later why it is important for us to keep track of the open range. And hopefully you've also been actively collecting numbers for the study that I asked you to perform in the last lesson, because it does ask you to include the numbers for the open range for each day. Now, the closing range. The closing range is really the final period in the session that you see. In this case, our final period is the letter E, and so the range for this period extends from this value here, which is at about 1269.50, all the way up to 1271.50. So once again, our closing range is the E period, and it's defined by those two key parameters. So now you've been able to identify the open range, the closing range, the value area, and the initial balance. The POC. This is always very easy for people to identify, especially since market delta also highlights it for us with a nice bright red color. And so here we see our POC right here at 1266.25. Now, it's also important to be able to identify the volume POC. The price POC was based on the value area based on price. Now, let's take a look at the volume POC, and the volume POC is, in fact, different from the price POC. The volume POC is the 1266 number that we see here, and the black line identifies that for us. All right, the last element that we want to talk about is the days open. It is always very important for you to record the day's open and the day's close on any instrument that you trade. At this point, I just want to bring your attention to the fact that you always need to record that's a very important number. And as we develop our discussion further, I will discuss and explain to you why that's the case. All right, now we're going to get into time frames and how time frames really impact or significantly impact our trading decisions. We talked in our last lesson a little bit about the fact that different traders have different time perspectives. Now, it is very, very important to understand that time frames can be a very powerful forcing point. What do we mean by a forcing point? Time frame that we trade forces us to make decisions differently because we have a time pressure. So for instance, if I'm a daytime frame trader and I know that the market is going to close and I have to be flat before the end of the day, I am now forced to make either a decision to cover my short, or if I'm going to be buying, I also need to make a decision. Do I want to be in a trade before the end of the day or not? So different points in time force different buy-sell decisions. And naturally, the shorter the time frame, the greater the pressure. It is a very different dynamic if I'm a short-term trader. And that's why individuals who choose to scalp or scalpers are often under a lot of pressure because they have to make a lot of decisions within a very condensed and a short span of time. Now, if you are a long-term trader, the time frame gives you more flexibility. You have different criteria by which you determine value and decide whether you're going to go in or get out of the market. There's certainly a lot more flexibility for you. So the important point that I want to make is that the time frame that we trade in creates forcing points. It compels us to make certain decisions at times. All right, now the short-term trader is all about a short time period or a short time frame, and basically we're going to limit that to a day, the period of a day. So the short-term trader has to make their trading decisions all within the span of the same day. So this impacts the whole psyche or the whole logic that they're going to use in making any trade decisions. Their trading behavior is going to be impacted by that, and basically they only want to trade in an area that has fair price for a number of reasons, and I'm going to discuss these reasons for you. But first of all, you need to be aware that a short-term trader's behavior is characterized by their desire for a fair price. That's what they want in the market. They want a fair price because they want an area that will allow them to enter and exit the market quickly, an area where there are a lot of buyers and sellers, and the only way they're going to find this in the market is if in fact they're trading in an area of fair price. The long-term trader, on the other hand, is characterized by the desire for an advantageous price. The long-term trader really does not have to make their buy or sell decisions based on a daily time frame. And so they have the luxury of being able to take a different time perspective. And therefore, what they're looking for is a bargain. They're looking for an advantageous price, meaning they want to buy the instrument when it's on sale, when it's really low. And at the same time, they want to be able to sell it when the price is really high. Unlike the short-term trader who wants to be able to get in and out quickly and only wants to trade around a fair price, they really want that advantageous price. quite often another analogy that's used in the market by traders on the floor is they'll tell you that the long-term trader wants to buy wholesale, whereas the short-term trader is willing to buy or pay retail. So where do we see activity from the long-term trader, and where do we see activity from the short-term trader? We talked about the fact that the short-term trader is going to want to sell and want to be active in the fair price area. So their activity is going to be in the fair price area, or another term that we know for this area, value area. The long-term sellers and the long-term buyers, on the other hand, are going to step in at the extremes. So if we are at an unfair high, this is an advantageous area for the long-term seller, and so they'll quickly step in and start selling. On the other hand, the long-term buyer will come in when prices drop so low that they are at what they perceive as an unfair low and pick them up. So long-term sellers and buyers typically are found at the extremes of our price range or the extremes of the profile, and short-term sellers and buyers trade with one another in the value area around fair price. Interesting question that we need to ask ourselves. How do we really know that it is in fact the long-term trader that is active at these advantageous prices? Why aren't those short-term traders involved at those advantageous prices as well? After all, we just said that these prices are a bargain. Well, the answer is really very simple. And the answer is, the reason that we know that for sure or for certain, only traders with a long-term time frame can take a chance on taking a trade in an area where the market doesn't spend much time. Think back again to what we said about the short-term trader. They're after liquidity. They're not after a large profit. They usually will trade a large position, and they're after a few pennies or a very small profit, because they're making a lot of different trades, and so they want to be able to get in, big position, and out quickly. If they do this at an extreme, they're going to get stuck. They're not going to find the volume that will allow them to exit quickly when they want to exit. So the only safe area for them to trade is really an area where the volume or liquidity is very high. And where is this? This is in the value area. And that's why we see a lot of prints in that area, because a lot of trading is going on in that area, a lot of activity, because that's where the fair value is in the market. At the extremes, it's very risky for a short-term trader to engage or to put on a trade, because they simply don't know whether they'll be able to get in or out of it, and they may get hurt. So they try to always stay within the value area. And the challenge, or the biggest hurdle that many short-term traders often have, is how to identify where that value area is. And this is very important for a short-term trader, to be able to know where in the market is the value area, where is it safe for them to trade, and where are the extremes. And this is why the profile is a powerful analytical tool that is used by a lot of the professionals, because it helps them see and identify where this value is. And I'll show you in a moment how the amateurs behave and how the actual professionals behave when they look at the profile. The purpose of the market for all traders is really to facilitate trade. And it does so by auctioning from high to low and low to high. So it's always moving, looking for a price area where trade can be easily facilitated. What do we mean by trade facilitation? Trade facilitation simply means being able to find lots of buyers and lots of sellers that are willing to work together or to transact together. Basically, the market is always moving, trying to look or to determine a value area, an area where a lot of volume can be traded and trade will be facilitated. There's a lot of activity. So the market is always looking for these price areas where trade can be facilitated. And when we say the market is looking for that, it is those short-term traders that are always looking for that value area so they can begin their trading activity in that area. Now, I don't want you to think the market is just about the short-term trader or the long-term trader. Both of them have a very important role to play in facilitating the trade process in the market. And interestingly enough, the role is a direct result of their behavior. So basically, by virtue of the fact that the short-term trader is always looking for value, they tend to create an area where there is a lot of trade activity, because the short-term traders will trade back and forth with one another, one buying and selling from the other, and in turn, this will create a lot of liquidity. And the interesting thing is, here's the role for the long-term trader. When prices start to get away from the value area, this is the time when the long-term trader steps in and starts to get involved in the market, all of a sudden pushing the prices back to the value area. So in the areas where the short-term trader is not inclined, I don't want to say afraid, but certainly shies away from trading the extremes, the long-term trader steps in. See, that's the role that each party plays. So each of them has their own niche and their role in facilitating the market and the movement in the market. The long-term trader comes in at the extremes, and the short-term trader becomes incredibly active in the value area. All right, our focus today is going to be on the short-term trader. We're going to spend quite a bit of time together analyzing and trying to study how a short-term trader can identify early on in the market an area of value. How do they do this? And it's not easy. All right. First of all, their objective as a short-term trader is to find a fair price in the market. And their role is to find this area where the two-sided trade can occur, meaning a lot of liquidity and a lot of volume. So that's the objective. We want to be able to identify this area in the market. It's one thing if I show you a chart after the fact and I demonstrate or display for you where it was. But now in the live market, how can a short-term trader do this? All right. The area is typically identified in the initial balance area of the day. So as soon as the market opens, the short-term trader is trying to identify where is the value area today in the market. And let's see how they do that. Okay. The initial balance. We talked about the initial balance a little bit earlier in our presentation today, and we're going to spend more time talking about it because it is a very important period. First of all, we know that the initial balance on a standard profile chart is the first two periods, or the first two 30-minute periods of trading. I want you to think of the initial balance area as a period of negotiation. Negotiation in a sense that buyers and sellers are interacting together, trying to determine where is the fair value in the market and what's really going to happen in the market during this trading session. So it's the time when the short term, the day trader, or as they're often described in the pit, the locals, because they're local to the floor or the pit, they try to find a range, a price range, where it's comfortable for them to trade. So as soon as the market opens during those first two periods, that's what the short-term trader is doing. They're trying to identify a price range. Where is it safe for me to transact business? The initial balance takes a little bit of time to establish. So this is not something that happens in the first 5 minutes or 10 minutes. The point that I want to drive to you is the initial balance time is going to differ from one instrument to the other. It is not always going to be the same. Think of the initial balance as the amount of time it takes the short-term trader to find an area where two-sided trade can occur. On some instruments, it can take, in fact, 10-15 minutes. On others, it may take half an hour. And on some, it could be a full hour. And it varies from day to day. It is not a set period. However, based on experience, professional traders learn to quickly identify in the market where this two-sided trade can occur fairly quickly, and I'll show you how. First of all, they look at the initial balance parameters, and these can change from one instrument to the other. And what do we mean by the parameters? Remember, the first parameter is the range, the low end and the high end of that balance. Okay, before we take a look and analyze how a short-term trader does this, let me quickly review again. The role of the short-term trader is to find an area in the market where participants consider that area to be fair. Value. They're looking for value. So the market opens and starts to move directionally in order to establish the parameters or the range that will define the fair value for that session. And that's why we see a lot of volatility when the market first opens, because it is trying to establish that range for the short-term traders. The role of the short-term trader is to find this area and to focus on it because they're going to trade in it. All right, so how do we know that in fact the short-term trader has found or is in control of the market during this period? The way that we know that is if in fact an unfair high and the unfair low are established in the initial balance and they hold throughout the session. If this is the case, then we know that in fact our short-term trader is in control. Now, I know that some of this conceptual stuff seems a little dry, but when you see it in action now, you'll begin to gain a better appreciation for how it works and how it actually develops in the market. So I have 3 days that we're going to look at, 3 consecutive days of ES mini trading. And the nice thing is that during all 3 days, the short-term trader was in fact in control of the market. So it will really give us an idea to clearly see how this is established and how this is determined as the market is developing. If you look at the profile before you for December 28th for the ES Mini, after the fact, it's really very easy to see that the short-term trader was in control. First of all, look at how limited the value area is. It's not a very large range. It's a very small value area. Look at the entire range of the day between A and B. All of the trading for the entire day took place during that initial balance period, during the A and B periods. Look at that. All the prints are all within that range. Immediately when you see that, that tells you that the short-term trader was in control. Now, you're seeing this after the fact, at the end of the day. But now I want to work with you to help you be able to identify this early on as it is developing during the day. All right, the first thing that we look at during periods A and B is the area of overlap. When you begin to see a lot of overlap between A and B, this is telling you that the short-term trader is in control. We really have not had any influence from a long-term trader. If you notice, we're printing in the same price area. We're getting the TPOs in the same range, and they're repeating, and therefore it doesn't look like we have much of a directional move. There are really no extremes in the price range or extensions. No one is pushing the market in any particular direction. This is a quick sign or signal for you very early on that the short-term trader is the one that is in control of the market. When I say short-term trader, I mean buyers and sellers. Now, I split the profile for you so it would give you a better handle on looking at the different ranges throughout the day. And let us take a look at the A range. We opened up here, and then we navigated up a little bit, and then we dropped again. The B range, we opened at the low of the A range. Again, we dropped a little bit, and then we went back up. And look at how prices all started to print in this area. We're getting a lot of activity in this very narrow, tight area down here. And that's all a telltale sign that the short-term trader is in control. We're not really seeing a lot of big movement or range extensions. There are no wide extremes. And so the day continues to trade within that initial balance. The traders get a little bit bold and they take prices up a little bit, but they come back down towards the value area. This is a definite indication the short-term trader is in fact in control in this session. Now let's take a look at the open for the day, 1255.50, and let's see where the close is. And notice 1255.25, 1254.50. Basically, from the beginning to the end of the day, we had a very little, very tiny movement for the ES Mini, showing us that in fact there was not much directional movement at all in the market. And if any of you are familiar with candlesticks, this would appear as a tiny little doji candle. All right, now I want to actually show you on a video, of course time-lapsed, how the day actually evolved and developed. Oops. Here we go. All right. Now, notice the prices drop a little bit, and they come back up a little bit. Now, actually, the day we just looked at was the following day after the 28th. And I wanted to show you this to show you where prices picked up from the close of the 28th. So let's take a look at it again. We closed at 1254.50 on the 28th, and now let's take a look at what happened on the 29th. Prices open right at 1256.25. So actually we opened up a little bit from the prior day. But once again, take a look at, oops. All right. Not much movement at all in terms of range extension. we're still in a very tight range. The short-term trader is definitely still in control of the market. Now, notice what happens when prices get out of the value area a little bit. They drop right back into the value area. Whenever you see very limited movement like that, it gives you a clear indication that, in fact, the short-term trader is in control. All right. This is the December 29th, which was the following day, and that is the video that we just looked at. And I want to show you how, when we look at the profile looks very bulged in a very short and tight and narrow range. Those are all classic characteristics of short-term trader control in the marketplace. Look at the AB range. Often you will hear this described as the base for the day. The base meaning the foundation or the base range. Prices don't really deviate or go very far from that range. All this is typical behavior of short-term traders. Short-term traders are in control of the market. So on the 29th, we open at 1256.50. And if we go back to look at the 28th, 1254.50 is where we closed, and this is where we opened. And now I want to draw your attention to something rather interesting or important. When prices started to move to the upside, okay, how much further did they really go from the open? If you count the TPOs, you will find that they really did not go that much higher. This is often a very good indicator when you see very limited range movement like that, that again, the short-term trader is in control. So we are going to learn to count TPOs. TPOs are very important, and they help us understand who's in control and how far out is trade facilitated and how big of an area do we have for traders to maneuver in. The larger and the wider the range, the more conviction in the market in terms of direction. The smaller and the tighter the range, as you see in these 2 days, the more uncertainty we have in terms of the market. No one is really sure about where the market is going to move, whether it's going to be up or down. So everybody becomes confined to a very tight and narrow range in the marketplace. All right, now we're going to take a look at the December 29th in a split profile. And here I want you to look at something that's interesting. As the day develops, look at where the open is for each time period relative to the prior range. So between A and B, B opened right at the same open of A. Now when we go to C period, interestingly enough, opened at the top range of B, but it dropped right away. And then D came in at the low of C, tested a little bit lower, but then came back up again. And sure enough, E opens right at the top of D. Notice again how many prints we have, how many TPOs. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Each TPO is a very tight, very narrow range. All of these are characteristics of short-term trader marks in the market. This is the area where the short-term trader is trading. We don't really see the footprints of any long-term involvement on the picture that we see in this window. And even when the prices ventured up a little bit, notice how they still stayed in very tight, very narrow ranges. If you count the TPOs again for H period, 1, 2, 3, 4, 5. For the I period, 1, 2, 3. For the J, 1, 2, 3, 4, 5. All very narrow, very limited ranges. It really shows you, again, short-term trader involvement uh, and no conviction, no certainty as far as direction. We're just looking for fair price and a safe area to trade in the market. And many of them are in and out within fractions or within a very small range. So this is comfortable for the short-term trader. They just want these areas of liquidity, these areas where you see a lot of prints. This is where they are trading, here and here. And at the end of the day, because there really was no conviction in terms of direction, look at what happened. The short-term trader decided to immediately sell. Now, unfortunately, the amateur or the inexperienced trader looks at a chart like this, and then here's what happens. When the market opens and it starts to drop, they think the market is going to go down. So here's what they do. They decide to short at this point. And they short only to see the market start to move back up again and move against them for the rest of the day. And eventually they will exit with a loss. So they didn't fare very well on shorting, on this short that they took, and now they're looking for an opportunity to buy. So they'll watch the market, and the market sort of stagnates here, and then right at this point the market starts to break. And so they want to be confident that the market is going to go up, and now since it has gone up since the morning and since the open, this is where they decide to buy, right here at the top at H. And sure enough, what happens as soon as they do that, the market reverts back to value area. They're thinking, oh, I've gotten the breakout, prices are going to start moving up, and just when they do that, the short-term trader moves price back into the value area. So this is the difference between someone that understands market behavior and someone that's just looking at price starting to search for breakouts and identify signals, and sure enough, they'll have signals up here telling them it's time to buy because prices have been going up. And similarly here, you might even get a signal that it's time to short. But if you look at the actual behavior and what's going on and who's in control of the market, you stay away from those types of trading decisions. And this is, again, the power of the profile. All right, so once again, just to emphasize, we always look at the initial balance area, A and B, and on the 29th, we had 1, 2, 3, 4, 5, 6, 7 A prints, and we had 1, 2, 3, 4, 5, 6 B prints. So really, in total, this was a very narrow range, and we had a small area of overlap. Typically, a small area of overlap is not characteristic of short-term trader behavior. However, I wanted to show you this example to show you that there are times when, in fact, you will see this happen, and it'll still be the short-term trader who's in control. All right, now let's take another look at it now at the video, given the new things that we have learned, and watch the profile develop. Okay, see now when it dropped down here, this is the point that I was telling you a lot of amateurs would come in and say, oh, well, the market is dropping, let me take a short here. And notice the volume is building up in this tight value area. Look at that. When it moves back up here and it looks like it broke out of the range and it's going to go up, this is when an amateur would say, okay, it's time for me to buy. But if I know and I understand the profile, I shouldn't be buying here. If anything, I should be selling because price is going to drop back into the value area. And let's watch what happens. And sure enough, at the end of the day, price drops quite a bit back to the low of the initial balance area. Okay, let's now take a look at December 30th, the following day from the 29th. And we have a split profile once again. This profile looks quite a bit different from the 29th. But nevertheless, this is another day where, in fact, the short-term trader was still in control. Let's take a look at how we knew this as the day developed. First of all, let's take a look at periods A and B, our first two initial periods. In this case, we have a large area of overlap. That's clue number one to short trader or short-term trader control in the market. They're the dominant force when you begin to see during the initial balance a large area of overlap. That's not definitive. It's just the first piece of evidence. And I should also tell you that there are times when the market can get tricky. The short-term trader may be in control for a portion of the day, and then all of a sudden the long-term trader steps in and changes the dynamics of the entire day. But that's the nature of the market. You can't ever really know exactly what's going to happen, but you at least have to have some sort of a frame of reference to be able to know where value is and be able to discern and identify the behavior of the different types of traders. So if you were looking at a profile and you thought the short-term trader was in control, and then all of a sudden you begin to see directional movement, you know right away things are changing. All right, so another exercise that we do, first we've identified that we have a large area of overlap. We actually count the total number of TPOs for the entire initial balance. And here on the 30th, we had 19 TPOs. If we count B and A together, so the full range, 19 TPOs. 14 for period A and 15 for period B. 10 TPOs in terms of overlap. So the bulk or the majority of TPOs that were printed were in fact overlapping. This tells us again, short-term trader is in control. So this is one of the ways that we can identify, counting the TPOs. Another way we do this is by actually looking at the range. How much of the price range was overlapped and how much total range did we have? And as a percentage, you are going to find that if you do it numerically, this is a fairly high, it's about 2/3 of the price was overlapped. All right, now let's take a look at a video for the 30th, the day following the 29th that we looked at. Let's take a look at the day and how it develops. Okay, now watch. The market opens at 12:54. And what happens? Prices start to move up. And that's typical. The market is looking for direction. The market is trying to determine who's in control and what am I going to do. The market continues up like that. Quite often, a trader will think, I have a directional day, because after all, I did not have a single print below the open. All prices since the open have been printing higher. This is usually very bullish. But let's continue on to see how the market continues to develop. Once B opened, we take a look at where did B open relative to A. And in fact, how many TPOs did we have for A? And if we count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, we had 11 TPOs. is this a wide range or is this a narrow range? The only way that we can know that is if in fact we've been studying our instrument. And this is why I've asked you to complete the study in the previous lesson to collect data, so you begin to develop a feel for the instrument that you're trading. This data will be very helpful for you in making these types of analysis. And you have to remember, the data has to be collected for different instruments. So the data that is relevant to the ES Mini is not going to be relevant on another instrument. And we always have to carefully study every instrument that we trade, or any instrument that we trade. Excuse me, I had a little frog in my throat here. All right, we'll continue on with the day as it develops. We have period B moving lower. And again, quite often when this happens and prices start to move down, the amateur will say, aha, it's time for me to take a short. And the minute they do that, look at what happens. C opens and C starts moving up. Now, look at where C opened relative to B. C opened below the half range of B. That is a fairly bearish open. And now take a look at the number of prints in C. The range is really tightening, and you will typically see this as the day develops. The initial balance is our widest range. This is on a day where the short-term trader is in control, and then the rest of the day people will say it will trade sideways, or the market is in consolidation. And what you're really seeing is the activity of the short-term trader developing a value area or trading around fair price, creating that sideways movement. Now we had a little bit of direction here. It moved down. And just as it got out of the value area, what do you see happened? Price got picked up and it started moving back in towards the value area. Once again, price came down to test the value area. Are we really going to drop? And sure enough, we didn't drop. Prices got picked up and we went back towards the value area. Now, when the market determined that prices weren't in fact dropping and they came back to the point of control and started to rise, now they're going to head up to test the top range of the value area. This is the negotiation process that I was describing to you earlier. Prices keep going back and forth trying to establish where the value is and what's happening at the extremes. Are prices facilitated? Can we continue to trade and expand the range, or do we meet support and do we meet resistance? And in our next lesson, I am going to spend a little bit of time talking about these key concepts of support and resistance, because they will add quite a bit to our analysis using the profile. Okay, so now let's see what happened when we came to M period towards the end of the day. M opened fairly high and we were outside the value area. And what did M do? It dropped right back into the value area. So at the end of the day, there really was no certainty about direction, and the safest thing to do was to come back and trade within the value area. And what happened was a lot of the short-term traders that moved price up started to immediately cover, and then we started to see some selling coming into play, and prices came right back down to the value area. And not only that, they continue to drop back to the POC. And you will always find that these POCs are very important numbers to keep your eyes on. Price always tends to navigate towards that POC. All right, and that was December 30th. All right, so let us recap and review what we've talked about today. We really wanted to focus on identifying and learning how to detect short-term trader control in the market. When is the short-term trader actually in control? And how does the profile show us and tell us that? First of all, markets don't move directionally when the short-term trader is in control. They simply rotate around a fair price. And once again, to review, why is that the case? Because short-term traders are looking for areas of liquidity, areas of large volume, areas where buyers and sellers are abundant. So it is easy for them to get in and out because they're not looking to make very large increments of profit on their trades. They're trading large volume and small profit. Even with that formula, they're fairly successful if they are confined, or if they keep their trading activity limited to the value area. They can still make quite a bit of money doing that, turning trades over and over again. As long as they've identified correctly that value area, it's easy for them: buy, sell, buy, sell, buy, and they do a large number of transactions during the day, and on each of those transactions they're making a very small percent gain, and those small gains add up at the end of the day. That's the style of the short-term trader. The key, though, is for them to accurately identify that value area. Short-term trader in control is also characterized by tight or limited range in price movement. When we have the long-term trader in control, you're going to see very wide ranges and big movements in the market. The opposite occurs when the short-term trader is in control. Last but not least, the short-term trader is in control when you see trading limited strictly to the value area or the market fair price. So these are the key elements that characterize the behavior of a short-term trader, and now we've identified how we can begin to discern if they're in fact in control, or if we have a directional market very early on when the market opens, by taking a look at our initial range and our initial balance and the extent of movement and overlap in those early periods. All right. With that, I'm going to conclude our session today.